money, that means you're losing money. If you're holding money, you're losing money. Anytime money comes, the money wants to be flowing. Right? Your current assets are just, don't say current, it means a very short period of time, like 1 year or less. So you have current assets. Hello, what's up guys? Today we're going to be talking about something very, very important. And then it's something that every single business owner, whatever business that you're doing, whether you're investing in high risk stocks, whether you're investing in low risk stock, in businesses, in commodities, in real estate, you really need to understand cash flow. And this is like the most important word in any business that you're doing. And if you don't understand cash flow, then you cannot understand money, because like you say, money flows. Money flows, that's why it's called currency. And if you don't understand how your money is flowing, whether in and out of your business, then your business is unlikely to make it or to succeed. So it's very important for you to understand this concept, cash flow. And in business, one thing that is often misunderstood is the mistake that so many business owners make, which is to mistake cash flow for profit. They think because they are profitable or because they made profits in this sales that they did or on paper, that means they are cash flow positive, which is something that is not true. So you need to understand. Let's take a stake, for example, we're starting a business. When you want to start a business, there's so many sources of funds that you can utilize. The first that's most important is your capital, and you are going to look at where you're going to get capital from. And just like I said, you have very important place from the financial statements. We have 3 financial statements. You have your income statement, you have your balance sheet, and you have your statement of cash flow. Or for whatever business that you're doing, let's say, for example, you're selling, you want to buy bread, for example, you want to buy and sell bread, or any commodities, let's say bread or palm oil or gold or real estate, whatever stuff is that. Now, the first thing I'm going to look at is your balance sheet. Now, you have various aspects. If it's a new business, you're going to take on debt, for example, or you're going to get debt, for example. Or if it's a business that you've been doing before and you have some savings, you're going to use what we call your retained earnings, right, to start venture into that business that you want to go into that asset class that you want to venture into. You're going to start with debt, which is a liability. You have 3 parts of the balance sheet. This is the balance sheet. You have your assets, and you have the owner's equity. Owner's equity here. So you can see this, that's why it's called the balance sheet. These two must balance with this one. Right. So for example, you're using debts. You don't want to use any earnings or any savings that you've had in the past. You're using debt of 500 naira, for example, and then that 500 naira is going to be equal to 500 naira in cash, your asset side. So you see they're balanced. You're not using anything here. So 500 here, 500 here. That's what you have. Now you want to use this asset to produce a business. You want your business to produce an income for you. And so from the financial statement of balance sheet, you're going to go to the income statement, just like I always say. Now in your income statement, you have your income, you have your revenue, or your sales. Now this revenue, you're going to make some expenses for whatever thing you want to produce so that you can sell. If you're a service business, you're going to have some operating expenses, some expenses that are directly related to the goods. These are cost of goods or services provided, right? So if it's a cost of goods, for example, you're producing bread, for example, the flour and everything like that, those things are going to follow that cost of goods, that particular direct cost of those commodities that you want to produce to sell. If it's barbing, for example, as a service, or if it's consultancy as a service, those things are directly related to the goods or the services that you are providing. Those are the cost of goods. So from there you have your gross profit. From your gross profit you have other things like that. You have other operating expenses, and these expenses are going to give you, then you have your operating profit. You're going to have your operating profit. So you can see I got a loan from the bank or from whoever, and then that became my asset, which is my cash, and then from there I used it to produce a commodity that I wanted to sell. And when I sold it, I had revenue, and from this revenue I got my gross profit. From this gross profit, I now remove other expenses that I have on trying to produce this commodity which I sold Those are what gave me, that's what I finally got as my operating profit. Now from this operating profit, you have some machines that you use in your businesses or in your company to produce these goods. Those machines you can have, or if it's real estate or whatever thing like that, you have what's called depreciation. Then we also pay debt. We pay debt on your, you pay interest on your debts, some loans that you've collected. Then you have interest payment, and from this interest payment, you also have things like amortization, and then you also pay taxes, right? You also pay taxes, and you can see, for example, in 2026. The tax system in Nigeria is going to take a very, very different shape, and it's very important for you to understand how the tax work in Nigeria, every single person, so that you don't fall victim of tax crimes, right? So now you have debt, depreciation, you have interest payment, and you have tax. So you remove all these things from the operating profit. Now, from your balance sheet, your income statement, you now have what is called statement of cash flow. Right, and from this statement of cash flow, you have the first thing, which is cash flow from operating. Cash flow from operating. Have cash flow from operating. Right. So now, why this is very important, because it's possible for you to be profitable on paper from the analysis that you've done, from the plus and minus that you've done, but you don't have that cash. You understand? For example, you sold some things on credit. You're going to record it like you're going to record it as I sold 5 of this commodity, I sold 5 of these goods. Meanwhile, you've not collected the money, right? So those things are not yet cash. You've not cashed them out, right? So that's what we're talking about, cash flow from operation. I'm going to see what it is now. And the first thing I'm going to have is your operating profits, for example, or if you've gone down here, you're going to have your earnings, right? Let's say you have your net profit, for example. You've subtracted all these things. You're going to have your net profit. So now your net profit, after you've subtracted everything, your net profit is your total earnings, right? Your net earnings. You're going to have your net profit. They are going to plus, or you're going to add your working capital. Now, working capital is another thing that is very important. Working capital is simply your current assets minus your current liability. It's very important for you to know, as somebody who is in business, you need to know your current assets and your current liabilities, right? Your current assets are just, when you say current, it means a very short period of time, like 1 year or less. So you have current assets, like you have cash, you have inventory. Inventory is also a current asset. You also have current liabilities. Those debts are able to pay in the space of one year. Talking about interest payment and whatever thing like that. So those are your current liabilities. So I'm also going to add your non-cash expenses. I want to talk about non-cash expenses. You talk about depreciation. Those machines, you're going to reduce the prices of those machines in terms of, you're going to say, you're going to adjust those machines in terms of depreciation. Like, for example, you bought a bike and then you're using this bike in a year. So at the end of 1 year or at the end of 6 months, this bike is expected to have depreciated, right? So you bought the bike for 1.5. So let's say you bought the bike for 1.5, but you're going to take a depreciation, meaning that this bike has reduced in price, reduced in value, I mean to say, of like 200 naira. So you're going to put 200 naira as depreciation. That doesn't mean that you've moved anything, you understand? It just shows that you removed it from here, depreciation, but you didn't remove it, you didn't remove any money, you understand? So that money is still going to be added back in terms of non-cash items, right? Non-cash expenses. So you're having depreciation back, added back. Anything that you have, you're going to remove all of them. You're going to remove your depreciation, remove it, your amortization, you're going to add them, I mean to say. So you're going to add non-cash expenses, those things that you put on paper that you spend, meanwhile you didn't spend on them. Then working capital, as I was saying, working capital is very important. Your current assets minus current liabilities. This way is very important. And in this place, you have in current assets, no matter any business that you do, talking about money, you must always see any financial business you are doing, any business you are doing, in terms of these three financial statements. They don't work separately, they work together. So I cannot look at a company's income statement and think that, yeah, this company is profitable, this business is profitable. It doesn't work like that. I cannot look at a company's cash flow. With the company's cash flow statement, I can really understand, but I want to know where the money is coming from. Then I cannot look at a company's balance sheet alone and understand that business, right? Also whether this company is making money or it's not making money from these assets that they have. The company has plenty assets and then it's not utilizing those assets, it's not producing any cash flow. I mean, that person is just wasting his time. So you need to have these 3 statements to really understand any business they're talking about. So under current assets, we have things like your inventory. Now I have inventories, so you're going to say that this is my inventory. The value of this inventory, you're going to also add you're going to add the value of your accounts payable, accounts payable, and then you're going to subtract your accounts receivable. That's talking about cash flow. This is working capital. You're looking at working capital, change in working capital. So you have inventory, you have accounts payable, you have accounts receivable. So if a business still has inventory, that's cash, that's valuable because you can easily turn those inventories into monetary value, into cash. You have accounts payable. Accounts payable is those things you have not paid. You are supposed to pay. For example, you bought some goods on credit, you've not paid. This is what we call inventory timing. You want to make sure that you increase your timing as much as possible. You want to be able to tell people, you want to owe people for a long period of time. You want to tell people that I'm going to buy these goods and pay you after 2 months. Let's say you got a goods of supplier's credit. This good is worth 400 naira, but you tell the person I'm going to pay you later, right? So you took the person gave you these goods, you've not paid. Now you made a profit of 200 naira. That means your total cash that you have now is 600 naira, owing 400 naira. You can use that 400 naira to do something that can produce income and produce cash before you even pay this person. So you can even use money to produce another income, which will now go to 800 naira before you even pay this person. That's what we're talking about. You want to increase your timing. Now your accounts payable, so you're going to have your inventory plus your accounts payable minus your accounts receivable. Money you're supposed to pay out. This money they're owing, this money that people are owing you. The money people are owing you is credit. That's the credit side we're talking about. So you want to get this credit side out as possible. You want to reduce the amount of people that are owing you. You understand? If you sell goods to customers, you want them to pay you as soon as possible. So don't let it be too long, because if it's too long, it affects your cash flow. The monetary value of those things is going to, because if the customer is going to pay you after 2 years, for example, you know that value, the monetary value of that amount has reduced. You understand? So you want to use money. You want to be using money as quickly as possible. Money does not stop. If you're holding money, that means you're losing money. If you're holding money, you're losing money. Anytime money comes in, money wants to be flowing. So that's why somebody will say the problem of rich people is that where do they put their money? Once money comes to you, it's very important for you to quickly throw that money somewhere else, so that to keep multiplying for you. You don't want to hold money, because you are holding money or saving money, you're losing money. So if your company has cash, too much cash for a long period of time, you don't want to be investing that money, because the company doesn't know what to do and is losing that money. So now you get here. Now once you get your net profits, you add your working capital. You want to ensure that this one is more than this one. Your inventory that you have, your accounts payable, they are more than your accounts receivable. You want to have a positive one, and once you add all these things, then you add your non-cash items to give you your true value. But if you have too many people owing you have so many people that you have sold goods on credit, then you're going to have a negative working capital, and you have your net profit minus your negative working capital plus your non-cash item, and this one will give you the true value of that cash flow. So what we mean that you can be profitable but don't have enough cash. You can be profitable but have a negative cash flow from operating. Means that you can be profitable on paper but lots of people are still owing you. That's just what we mean. You can be profitable on paper but you don't have, lots of people have not paid you. That's what we mean. And it also means that generally in your business you can be unprofitable, because we're going to look at other items like your cash flow from investing and cash flow from financing activities. All these things are very, very important for you to understand. And if you don't understand these items, it's going to be very, very difficult for you to understand your business and see how money is flowing in and out of your business. If you found value from this video, make sure you subscribe to this channel and like and share, and I'll see you in the next